Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending November 11th, 2022. And this week's video I'm going to title CPI Comes in Light, Sparking a Year-End Rally. And this was light on the economic data this week, but a very important piece of data did come out, which was the CPI figure, which I'll show you in a second. But I want to touch first on the M2 money supply. And this is something that is generally pretty boring. It's kind of before the pandemic, kind of range between 3 and 6% most of the time. And you didn't really have a pretty benign disinflationary environment before then. And then during the pandemic, you suddenly saw M2 growth explode, all the way peaking in the high 20% range in early last year. But it really started to take off, I want you to notice, in the second quarter of 2020, to 10% in March, then 16%, and then 21% as of May. And what you see is that if you look long term, there's typically about a 6 to 8 quarter lag between M2 growth or deceleration to where that feeds or when that feeds into inflation. And that's what you can see here is the CPI number, which did come in a little bit light on this latest report, 7.7%, a couple tenths of a percent lower than had been expected. But what I want you to pay attention to is when this really started to take off, which was the fourth quarter of last year. We had through the summer of last year, we had elevated inflation, 5%, but it wasn't really a huge talking point until the fall, winter time of last year. And that's when Jerome Powell was saying inflation's transitory, and obviously it wasn't. And at least depends on your definition of transitory. But what you can see here is that it accelerated through really the last couple of months, all because what did money supply do all through basically the back half of 2020 and into early part of 2021? It accelerated all the way up to, like I said, 26.7% as of February last year. So, but what you've seen since is a sharp deceleration in money supply all the way down. We got down to the low teens in the summer of last year, and now we're all the way to 2.5%, which is even lower than we were pretty much any time before the pandemic. Obviously, this goes back well into 2010 when you had very poor economy, very low money supply growth, and that does not portend well for the economy 6 quarters out because there's going to be a lot of deflationary forces. But as of right now, what you're going to see really now through next year is a sharply decelerating inflationary environment. On the physical goods market, you're already seeing flat to negative prices. We talked about this before, the dynamics of people over consuming physical goods during the pandemic, and now they're shifting over to services, and that means an oversupply of physical goods in the marketplace, and that's why you're seeing a little deflation on that front. Really, the inflation right now is coming from the services side of the economy, and that's keeping that elevated, but it's likely to continue to come down. And here's the core CPI number. That one also came in after accelerating last month, came in at 6.3%. So, and that's what the market wants to see. What the Fed wants to see is that CPI figure, core CPI figure, decelerating. So that's the story about inflation, and that really sparked a rally in markets on the expectation that the Fed is going to slow or probably pause its rate hikes. Actually, before I get over to this, let me do that. Let me go to this figure. Let me go here. I'll pull up the CME once again, which I know we kind of follow, but I want to give you an update. You can always head over to this FedWatch, CME FedWatch tool. But basically, we're now at an 80% chance of only a 50 basis point hike in December. And that was a week ago, a pretty good chance of a 75 basis point hike. So that certainly sparked a rally, that Fed dovishness that's being priced in. And then same with February. Now only a 53% chance of it being 50 and then 25 in February. And frankly, I think by the time you get to February, you're going to see 2 more CPI prints that actually 3 more CPI, and actually, yeah, because it's February 1st. So 2 more CPI prints that are probably going to see continued deceleration. And I could easily see this going to no rate hike in February. And I think that's probably where we're headed over the next few months. And that's why the market really liked this number. And you saw the sharp rally. You see that on Thursday. Huge up day, 5% on the S&P, 6% on the NASDAQ, and then another follow through day on today, on Friday. By the way, it is Veterans Day. I want to thank all those veterans out there for your service. And that's also why the bond market was closed. So if you look at the data in the bond market, it's basically going to be flat on the day because there's no activity because the bond market's closed. What you can see here, though, is the 10-year has come down pretty nicely. I said this was major resistance at 4.25 on the 10-year, and we've pretty much started to come in dramatically since then, down to 3.8%. And if you pay attention to like IEF, which was that was down a little bit, so that portends to slightly higher rates on Monday. But overall, the currency market, that one's showing another follow through, so that's kind of actually pushing more towards lower rates on Monday, but we'll see. But in general, what you're seeing is a pullback on the dollar, pullback in rates, on this pricing and expectation of a Fed pause, and I think that's likely what you're going to get. The market typically is smarter than the Fed, and they will price in the Fed action, and they're pricing in that pause. Now, you had huge rallies in the NASDAQ, up 200 points yesterday. On Thursday, the loss on the NASDAQ for the year was cut by a quarter in just one day. So that was how strong the move was, and you had follow through again today. Now, there's likely some overhead resistance here. So we're into that right now. This is a 382 retrace from high to low. So it would not shock me to see consolidation next week. That's kind of what I'm expecting. And then we start getting into the holiday season. And we know that during the holiday season, you typically have low volume, upward float in the market. And that's kind of what I'm expecting for, into mid to late December. And then you get into tax loss selling, and then there could be other issues of year end. But I do think this, I've been saying this for about a month now, that based on sentiment being very negative in early October, that reversal on the Fed announcements that was supposed to be hawkish, but the market reversed. That was here on this reversal day here. So just a lot of things lining up for a rally. Now the question is, how far does it go? Does it just get to this? Are we done? Are we just going to chatter sideways and go lower? Probably not, based on this recent thrust. Probably going to go to this next level. Maybe it's over the next week. Maybe it's over the next month or two. It's hard to know exactly, but these are the overhead resistance levels. 4150, that's kind of my base case, and potentially all the way up to this 43 level on the S&P. A lot of people underinvested, probably chasing into year end. I definitely could see that happening, and people positioning to try to catch up and get some gains going into year end when it's been a tough year for most. Now, the growth to value trade, you're starting to see, because rates are coming down, you're starting to see growth get a little perk up here, and that's another thing. I wouldn't be surprised to see a lot of short covering rally and a little bit of strength in the growth side of the market now that rates have paused and kind of pulling back. So definitely on the radar there. Now the VIX, that one came down, and that was kind of a tell of another rally. We didn't make new highs on the VIX. You made a lower high. And I'll be interested to see, do we make a lower low? If we can start, look at this. This is a series, really since last fall, when the Fed embarked on their tightening policy. What has the VIX done? It's been in a large, choppy uptrend. Do we start a downtrend? Right now, we're more in a wedge, right? Lower highs, higher lows. We'll see. TBD, something I'm going to be watching into year end. Let's see. Short-term rates. Here's SHY. That's come back up, hitting resistance, but just showing that the market is pricing in a lower ultimate peak in the Fed funds rate for this cycle. Now, the dollar rolled over Talked a little bit about that. This is clear. Look at this. Broke right through that 100-day moving average and probably headed to this 200-day moving average, most likely. And if you look at the different currency pairs, here's the euro, that one breaking through nicely to the upside. Same with the yen. Now the euro, that's getting some strength on the back of, hey, Russia's pulling out of some major important cities in Ukraine. And maybe they're reversing their policy. We'll see. Maybe that's the first step. But the euro is definitely getting a bit of strength. You actually have a seasonally warm winter in Europe, and so that's certainly helping the euro and not have to deal with potential energy crisis. The longer it stays warm there, the longer the better chance they'll have getting through the winter with enough natural gas. So that's where you're seeing strength there. You're seeing strength here in the yen, even the British pound. That one, remember the whole debacle with the gilt market? Well, that's completely reversed and then some, and headed higher. And you're seeing a lot of short covering, and that's really what I think a lot of this is. When you see these strong up moves in normal markets, the market takes the stairs up and the elevator down. In a bear market, or at least that's in a bull market. In a bear market, it's the opposite. You take the stairs down and then you take the elevator up. And that's kind of what you're seeing in currency markets and equity markets right now. So it doesn't mean we're out of the woods. Potentially could be the start of a bull market. But that's still TBD. Now, what did do well this week was gold after kind of languishing. That broke out. Here's GDX, and then here is GLD. There we go. That one clearly well above the 100-day moving average and likely headed into this 200, which would be this major resistance. So like in the gold market overall, precious metals in general, and you're still seeing some leadership out of the names you would expect for this market, even though the growth side of the market's getting a bit of a counter trend rally compared to value. You're still seeing strong relative strength. XLE touching new 52-week highs this week. You also have the basic materials. Here's IYM. That one breaking out now above the 200-day moving average. One of the rare sectors above the 200. Here's XLI, the industrials, also well above the 200-day moving average. But you look at the SMH, still below the 200-day moving average. Here's XLK, still below, barely above the 100-day moving average. SKYY, the cloud computing ETF, not even above last week's high. So you're seeing some relative weakness there. So underneath the hood, even XLY, let's go to XLY. This is consumer discretionary, not doing that well, right? Retailers, there's RTH, not above the 200. So you're still seeing that relative underperformance in that part of the market. But the bread and butter of the economy, transportation, that one now above the 200-day moving average. ARC is getting a counter trend rally, but still very weak overall, not even above the 100-day moving average. One thing I continue to see that bodes well just for markets in general, that there won't be this major meltdown, is the investment banks to the commercial banks, and that strength is showing that hey, there's going to be a better future for sales of bonds and IPOs and M&A activity, all of that, and the fact that they're doing well compared to those traditional commercial banks and really breaking out to the upside has to make you at least modestly bullish. It doesn't mean you have to be a raging bull that we're going to go to new highs. I'm probably not in that camp, but at least near term, it's hard to be super bearish with the breath thrust we've seen over the past week, with the Fed now in likely pause territory, and the dollar, which was the wrecking ball throughout the year of just a bastion of strength and causing problems in the gilt market, in the Japanese yen. It's just, you're seeing some relief here. This is, I think, a relief rally is the best way to describe it. And it's a pretty strong one. But relief rallies can turn into bull markets. They don't have to end in tears with another downturn. So that's where we're at now. And things could change, but you have to call it as you see it. You can't chase headlines. I know what happened in crypto and FTX. That was pretty sad, pretty crazy. But markets are rallying nonetheless. And overall, you have to be at least bullish in the near term, as am I, and I have been for roughly a month or so. So that's my take right now. Still continue on this path. Still overweighting value over growth, even though you're getting a counter trend rally. But the near term relief rally we're seeing likely has a bit of legs likely until year end. But no guarantees. We'll be at it again next week, calling balls and strikes and giving you the rundown of what's happening in the economy as well as markets. I want to thank you all for tuning in to not only this video, but our podcast, InvestTalk, which airs every weekday. You can subscribe to that. And I hope you have a wonderful weekend. I want to remind you that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. You have a wonderful weekend.